Namaste to all my friends. It's a great pleasure to go into the financial stability report of June 2026, which is released recently by the Reserve Bank of India. It's a collective report of the Subcommittee of Financial Stability and Development Council, and it is released by RBI Governor, and it is driven by SEBI, IRDA, that is Insurance Regulatory and Development Authority, PFRDA, there is a Pension Fund and Regulatory Development Authority, the IBBI, Insolvency and Bankruptcy Board of India, and IFSCA, that is the GIFT City, a new regulator which has been established in 2020. So these are the collective report of all the financial sector regulators, and it focuses on the emerging risks to the stability of India's financial system. It covers banks, NBFCs, insurance companies, mutual funds, Clearing Corporation of India, and the broader macroeconomic backdrop. Why June financial stability report is important? Because the whole financial sector is exposed to the West Asia crisis, and the interconnected risk and the geopolitical risks have been rising, and the entire scenario has become much more unpredictable, though things are settling down now. But when the report was made, it makes an interesting reading about the riskiness to the financial stability of financial sector. In June 2026, the FSR is a more critical due to the eventful period preceding its release. The West Asia conflict, now in its fifth month, has pushed the crude oil prices to nearly $100 per barrel. And the RBI has recently released two new regulatory standards. One is the expected credit loss framework, and the other one is the Basel Committee 3.1 or Basel Committee 4. It is commonly known as. These two frameworks will come into effect from 1st of April 2027. This makes the FSR of June 2026 much more significant in the backdrop of these developments. The FSR affirms that domestic financial institutions in BFSI sector is structurally strong and resilient and well positioned than most peers to absorb the shocks. They are well in place, robust capital buffers, and improving asset quality empowers BFSI sector. Whereas the global financial risks remain elevated due to the ongoing conflict and the geopolitical fragmentation, public debt concerns, and the stretched asset valuations. Persistent supply chain uncertainties can tighten financial conditions and revive inflationary pressures, posing elevated risks. Rise in public debt levels, fragilities in bond markets, and stretched asset valuations and a leverage among non-bank financial institutions remain key areas of concern. That is what the financial stability report has indicated. And it's quite interesting for the banks to analyze and put it in the right perspective to analyze its internal architecture of risk management, to realign it to face the upcoming risks. It identified geopolitical fragmentation, creating supply chain disruptions and energy market volatility and trade realignment, and rapid advances in artificial intelligence as structural forces which is reshaping the global economy and the financial system. AI is generating optimism that may mask underlying vulnerabilities and susceptibility to global spillovers. So the financial sector players should understand these dynamics. India's sound macroeconomic fundamentals built on strong growth, moderate inflation, healthy financial sector with adequate capital and liquidity buffers, and non-financial firms are providing a strong foundation to the financial stability of the financial sector in India. Due to the inflation risks, the central banks of major economy may follow a hawkish tone that is of the monetary policy. The near-term risks of these vulnerabilities could be daunting. Expanding role of leveraged non-bank financial intermediaries is also flagged as a systemic concern. Banking and financial sector in India is in a better state. A multi-decadal low of gross non-performing assets at 1.8% in March 26, down from 2.3% in March 2025. Credit quality improved with diversity, where farm sector still suffers with a GNPA of 5.1%. So there is a farm sector concerns because of the El Nino impact and the rise in the fertilizer costs and urea costs because of the West Asia crisis and the partial closure of Strait of Hormuz in Iran. These are all going to give some kind of an added risk to the farm sector in the coming year, that is FY27. The annual slippage ratio of loan accounts have dropped down to 1.2% in FY26. So we will have to guard that in FY27. The share of large borrowers in total bank credit also increased to 44.5%, but its asset quality is dropping to 2.4%. That is a good development. And the capital adequacy ratio of the banking system is between 16.5 to 17%, much beyond the mandatory level of 11.4%. So we have strong buffers as far as the capital adequacy is concerned. Banks and non-banking financial institutions are maintaining comfortable liquidity with liquidity coverage ratio and NSFR, net stable funding ratios, in a comfortable position, healthy profitability and low NPAs and a robust credit growth. Hence, banks are on strong footing to withstand severe macroeconomic shocks if at all such situation arises with their capital buffers. Another interesting point of FSR, every time FSR tests the durability of the financial stability with three scenarios, that is a very good reading of the riskiness of the financial stability. The stress tests conducted by the central bank indicates that the lenders are capable of withstanding severe economic shocks. RBI stress tests suggest some banks may have to draw on the capital conservation buffer under adverse macroeconomic situations, though they will be much above the minimum capital requirements as far as the capital adequacy is concerned. Banks' efficiency indicators slightly weakened during Q4 of FY26, and the same signages may precipitate during Q1 of FY27 and Q2 of FY27. This is what is the expectations. NBFCs also remain financially sound with strong capitalization, healthy profitability and improving asset quality. Their higher foreign currency borrowings has helped steady funding costs, but it raises vulnerability to exchange rate volatility even with most exposure are hedged. The strong solvency ratio of life insurers staying beyond the minimum threshold indicates its resilience and strength. Now, what are the emerging risks which the financial sector may have to face? One, the FSR flags that stable coin risk could threaten India's monetary sovereignty, facilitating or leading to money laundering that could impact financial stability. That is one risk which has been flagged. Rapid growth of digital lending through fintech channels has created a portfolio quality concern that the report specifically flags. So the use of digital platform for lending operations has to be viewed with caution. Higher GSEC supply and softer demand from insurers and pension funds are keeping long-term yields elevated even as short rates fall on easing and liquidity, creating a structural yield curve steepening that effect and the bank's investment portfolio. So when we sum up all these factors, we can get the cue that banks and NBFCs and insurance companies, that is the whole of BFSI sector, is comfortably placed, number one. Number two, there are risks which may impact the net interest margin of the banking system in the coming times because of the probability of default increasing. That can bring the NIM under pressure, and the credit costs may also go up. These are some of the things that one has to look at, and that is the reason why the holistic management of the balance sheet will become very, very essential for the banks. On the whole, the financial stability is intact, but the risks are on the horizon, and hence the financial sector players have to keep their radars active, and their risk management systems must be robust enough to be able to insulate the financial institutions against any signages of weaknesses. So we will be talking more about these kind of reports which will be released by the Reserve Bank and other think tanks. In the meantime, any other topic of interest that you are looking for, please do put it in the comments. Share these videos with your friends. Please subscribe if you haven't subscribed. And if our work looks good, please share and like it. And try to see that more number of people are learning from these educational videos. The very purpose of this channel is to disseminate knowledge. Thank you very much. See you in the next edition.